Blackstone's private equity team asked this question in a recent first-round interview. Walk me through how an LBO works. So if you want to work for a firm like Blackstone or other top private equity firms like Apollo, Carlyle, KKR, or TPG, you'll need to know how to answer this question. Heck, forget private equity. Even if you just want to work in investment banking, you'll still need to know how to answer this interview question. Oh, and by the way, in case you didn't know, Blackstone only accepts 1 out of 400 applicants each year. That's a ridiculously low 0.25% acceptance rate, making Blackstone one of the world's hardest firms to get a job at. So to help you have a real shot at breaking into top firms like this, I'm going to break down this question in this video. And I'm going to do it in a way that's so simple, even a 6th grader could understand it. And once you understand it, you won't have to memorize this answer by brute force, because memorizing answers doesn't work, since your interviewers can always change how they ask the question, and they're almost never going to ask the exact question that you happen to memorize. I can guarantee you that. Now, if you're new here, I'm Sam, a former technology investment banker at Morgan Stanley. Today, I run Wall Street Mastermind, where we've helped over 1,300 students who have collectively secured offers from every single bulge bracket and elite boutique investment bank on Wall Street, as well as other top-tier private equity firms like Blackstone, KKR, Carlyle, and Bain Capital. Now, in this video, I will share with you how we've taught our successful students to go out and ace some of the toughest interviews out there. So let's dive in. The first thing to know is that an LBO stands for leveraged buyout. It's when a private equity firm acquires a company using debt to pay for a significant portion of the purchase price. The reason an LBO works so well is because the free cash flow generated by the business can then be used to pay down the debt. This reduces the amount of money the private equity firm has to pay, which in turn increases the returns they can generate from an investment. The best way to visualize the mechanics of an LBO is to use an analogy. It's like the real estate investor who buys an investment property. The investor puts down 30% for a down payment and then pays for the rest by taking out a mortgage. The house is then rented out to a tenant whose rent payment each month is then used to make the mortgage payments. And throughout the time of ownership, the investor can also remodel the property to appreciate its value. Then once the investor has paid down the mortgage, they can then sell the house, and they can take back the majority, if not the entire sales proceeds, despite having only put down 30% of the house. And because we made improvements to the property through all the remodeling work, it is now worth more than its purchase price originally. Essentially, the investor ended up paying 30% of the previously lower value and selling it for 100% of the now appreciated value, right? And as long as the house is always rented and the renter always pays on time, it's clear why this property will be a very lucrative investment. So what does that have to do with an LBO? Well, the private equity firm is the investor in this analogy. The company being purchased is the investment property. Now, let's say the private equity firm puts down 30% of the purchase price with its own money, which is equivalent to the down payment. Then the private equity firm goes out and borrows the other 70% to finance the transaction. This is like the mortgage. The company generates revenue by selling its products or services, which is equivalent to the rent from the tenant. But to generate revenue as a business, you also incur a lot of expenses where cash is going out the door. Some examples of these costs include paying for employee salaries. They also include things like office rent, advertising, and office furniture, right? So you have to subtract these expenses from the revenue that's coming in to get to your free cash flow or the cash that's generated by the business. Now, coming back to the rental property, you also have expenses here as well. You have to pay the property manager. You have to pay for insurance. You have to pay for maintenance and repairs, and you have to pay property taxes. So you also have to subtract these items from the rent you get from the tenant. The cash that's left after that is what you can use to make the monthly mortgage payments. And as we mentioned earlier, the investor can also try to raise the property value by doing some remodeling work. This is like how a private equity firm will make operational improvements to the acquired company. They do this to grow the company's revenue faster or to increase profit margins. For example, launching new products or changing prices can increase revenue growth. Improving marketing or hiring more salespeople can also increase it. On the other hand, cutting costs can improve profit margins. So can streamlining the org structure to reduce headcount and payroll. Now, assuming the private equity firm made sound changes, the business they sell should be bigger and more profitable. That makes it a more valuable business. Now, during the holding period, as the mortgage on the house is being paid down, the real estate investor's ownership in the property is increasing. This continues until the mortgage is completely paid off, at which point the real estate investor owns 100% of the property outright. The same thing happens in an LBO. The debt used to finance the acquisition is paid down with the free cash flow generated by the business. The private equity firm's ownership in the business increases gradually over time. If and when the debt is paid down completely, the private equity firm owns 100% of the company outright. So how does this all work out mathematically? Well, let's help you visualize it by plugging in some numbers. Let's pretend the company was bought for $100 million. The private equity firm puts in 30%, which is $30 million, and they finance the other $70 million with debt. Now, during the 5-year holding period, they're able to pay down $14 million of debt each year with the free cash flow generated by the business. So by the end of year 5, the $70 million in debt is completely paid off. Now, at this point, the private equity firm decides to sell the company to someone else. Thanks to the operational improvements, the company has grown larger and become more profitable. So instead of being worth $100 million, the company is now worth $120 million. And since there's no more debt that needs to be paid back, the private equity firm gets to pocket the entire $120 million. And since they only put in $30 million to purchase the company initially, they've quadrupled their money in just 5 years. Now, quadrupling your money in 5 years is the equivalent of a 32% IRR, which stands for internal rate of return. That's just a fancy way of saying if you invested $30 million 5 years ago and you made a 32% return each year and compounded that for 5 years, you will come out with $120 million. Now, imagine if the private equity firm didn't use any debt. So let's say they paid $100 million upfront instead to buy the company. And assume the private equity firm still sells the company for $120 million at the end of 5 years. So they get $120 million from the sale, right? And they also get $70 million in extra cash from the balance sheet because they didn't have to pay down any debt. So that gives them $190 million. Well, going from $100 million initially to getting back $190 million is almost doubling your money, which if you do that in 5 years is an IRR of 14%. It's not bad, and it's still better than what you would get if you just invested in the S&P 500, but which would you prefer? 32% annual returns or 14%? In summary, an LBO can be a very lucrative way to buy businesses if the company acquired has steady and predictable cash flows that can be used to pay down the company's debt. This is why the use of leverage in an LBO is so powerful, and this is the key to the entire private equity business model that elite firms like Blackstone are built upon. Anyway, I hope this video gave you a good understanding of how a leverage buyout works. The next time you get asked this question in an interview, hopefully you'll ace it. Now, if you would like more hands-on and personalized coaching with your investment banking or private equity interviews from our team of coaches that includes the former global heads of recruiting at top investment banks like Goldman Sachs, Credit Suisse, UBS, and Lehman Brothers, then please don't hesitate to reach out to our team. Oh, and this is actually our first time creating a video like this, breaking down the most commonly asked technical interview questions. So if you found this video to be helpful, please hit the like, subscribe, and share button so that we know to make more videos like this for you in the future. And as always, remember, nothing worthwhile comes easy, and nothing is more important than your future. So keep grinding.